Good afternoon. You're watching Bloomberg Quint Live. Here are the headlines. Benchmark indices slip after record opening. Nifty inches towards the 10,500 mark. India VIX cools off. HDFC Bank's board approves fundraising of up to 24,000 crore rupees. The bank plans to raise up to 8,500 crore via preferential issue to promoter HDFC, while the remainder will be raised via issuance of shares. Religare hits upper circuit after Edelweiss Wealth Management is set to acquire its securities business. Maruti is one of the top gainers and the Nifty crosses 3 lakh crore of market cap. The stock hits 10,000 rupee mark in early trade today. With that, it's over to Darshan Mehta for Hot Money.
Thank you, Alex. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news channel. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Before we start with Hot Money, we're nearing the end of 2017 and it's been a good year for Indian equities, but some stocks have performed a lot better than the others. We at Bloomberg Quint bring you the multi-baggers of 2017 and the story behind them. And today we feature Bhansali Engineering Polymers. Soumit Sarkar is standing by with the analysis. Soumit, tell us about the company and what was the reason that the rally did happen in the counter.
See, now if you see year to date, the share price of the company has increased nearly 8 times. So let's first see what the company does. Now, BEPL is a 2,900 crore market cap company manufacturing Absolac, which is commonly known as ABS. Now, ABS is a plastic material commonly seen as in cars as bumpers, as spoilers. It is also used as a raw material in telecommunications and luggages. Now, the company has a production capacity of ABS of around 80,000 tons per annum. Now, if you see the financials of the company's revenue has seen a stable growth. And if you see the EPS, in the first half of financial year 2018, the company has seen more earnings as compared to the full financial year 2017. In the first half of financial year 2018, the company has an EPS of 2.5 as compared to 2.1 in full financial year 2017. And this is on the back of its improving margins. You can clearly see here how the EBITDA margins have increased from 10% in financial year 2017 to 14% in the first half of financial year 2018. Also, the company has no long-term debt on its balance sheet. Now, let's see what has worked in favor of this company. Now, the ABS manufacturing market has only 2 players. First is BEPL, second is INEOS. Now, so there is more much competition in this market, and the demand, if you see, for ABS is around 2,75,000 tons per annum annually in India. But these 2 players are only able to meet the half of the demand, while the remaining 50% is met through import. So there is a clear demand-supply gap in the domestic market of India. So to meet this demand-supply gap, the company is planning capacity expansion. So they are planning to expand their capacity to 1,37,000 tons per annum from current 80,000 tons per annum by December 2018. They also have a long-term capacity expansion plan where by financial year 2022, they are planning to set up a new unit which will have a capacity of close to 2 lakh tons per annum, and this unit will be situated near a port in Gujarat so that they can tap the international market demand also. Now, if you see, the third thing that has helped the company is that joint venture with Nippon, which has helped them to tap the auto manufacturing market. Now, this joint venture has significantly helped them and got customers from the auto manufacturing side. Lastly, what has helped them is a steady rise in volumes. In financial year 2016, they had a volume of close to 44,000 tons per annum, which has increased, and in financial year 2018, they're expecting a volume of close to 72,000 tons per annum. Now, comparing BEPL with its only competitor INEOS, if you see, the revenue growth has been stable and similar to that of INEOS. But when you see the net profit and EBITDA growth of BEPL, it is significantly higher when compared to INEOS. Now, BEPL's net profit and EBITDA grew at a compounded annual growth rate over FY12 to FY17 at 132%. That was the net profit growth rate, and the EBITDA growth rate was close to 43%. Now, if you see on return ratio side, the company's return ratios are also better than INEOS. Return on equity was around 22%, return on capital employed 34%, and return on asset 8%, as compared to INEOS 11%, 16%, and 6.6% in financial year 2017. Now, if you see on the valuation side, on FY18 PE and EV to EBITDA, the company is cheaper when compared to INEOS, but when you see the price to book, it is a bit expensive when compared to INEOS. Now, FY18 PE of BEPL is around 34 times, while FY18 EV to EBITDA is around 44 times, as compared to 48 times of INEOS and 47 times of 47 7 times when you see EV to EBITDA. Now, lastly, let us see what are the risks that are involved with BEPL. Now, fluctuating raw material prices. Now, raw material is a major cost of the company, and we have seen a lot of fluctuations in this raw material prices. So, any volatility going forward could impact the bottom line of the company. And also, this raw material prices are majorly imported by the company. So, there is a currency fluctuation risk that comes in with this, and also the company does not have any hedging policy, which increases the currency fluctuation risk for the company. And lastly, any delay in this planned expansion that the company has of increasing the capacity to 1,37,000 and 2 lakh tons per annum. If there is any delay, there could be a potential market share loss for the company.
Okay, many thanks for that, Soumit. A wonderful presentation on BEPL. But let's welcome our experts on hot money, Chintan Vora of finance.com and Amit Mantri of 2.2 Capital. They join us on the show. Thank you both of you for joining me on the show. Today on Hot Money, we'll discuss stocks like Exide, M&M, Oracle Finance, Mass Financial, as well as Tata Investment Corp. Let's start with the first one, and that is Exide. The counter is rallying over the past few days. Even in today's trade, the counter is up almost 1.3%. Over the past few days, the counter has managed to rally almost 10%. What is the way ahead for Exide? Is it a good bet, or should someone switch to an Amara Raja, which has been also performing? So what's the view on the battery space? Let's ask our guest. Amit, what do you make of Exide, bullish or bearish stance on the counter?
So I'd be bearish on Exide. The reason being, when you look at the near term, Exide has some growth challenges. Some of its key segments like telecom and inverter are unlikely to be growing as fast as they were growing in the past. And they constitute a large part of the business revenue for Exide. And when you even look at the longer term picture, the worry with the battery segment is how do the players like Exide and Amara Raja perform if there is a shift towards lithium-ion batteries. Both of these companies don't really have technical capabilities in the lithium-ion segment. In fact, Exide particularly does not even have any technical tie-ups as well with the leading lithium-ion manufacturers globally. So it's a serious risk. It will not pan out again in the next 1 or 2 years, but we are moving towards electric vehicles. We are moving towards lithium-ion batteries globally as well. If Nitin Gadkari has announced that by 2030, there are aggressive targets of moving towards electric vehicles, be it buses, be it other public transport, and be it passenger vehicles. When that happens, players like Amara Raja and Exide will struggle probably. So now, a lot of other geographies are talking about going 100% to electric vehicles. India might not do that, but even if 20-25% of the vehicle sales start becoming electric vehicles, these businesses will start facing challenges. So so there's a risk of this, longer term perspective. In the near term, also there are growth challenges. The only positive that we can see with both of these companies is largely the GST related benefits, which is gaining market share from the unorganized segment. That might also lead to some pricing improvement for them, because if you see, it's largely a two-player market, yet for some reason they don't command the kind of pricing premium that you'd expect in a less competitive market. So GST might add to the a bit to the bottom line and the top line, but longer term risks are fairly clear in my view. So therefore I'm negative. The current valuations don't account for the near-term growth challenges as well as the longer-term business model risks as well.
Do you think that the current price includes the potential insurance business that they had, or if that happens, then the trigger could be definitely there?
So I do not actually ascribe a lot of value to the Exide insurance business, largely because it's still small, subscale. It's not a meaningful player in the overall market. So I wouldn't give a lot of value on the overall Exide business to the insurance business. In fact, you can also probably think of giving it a negative value, because there is still a lot of time before it starts making money.
Okay, and just one question before I move to Chintan. Have either of these companies indicated the willingness to move into electric vehicle batteries? Have they said anything on that front, if you're aware?
Amara Raja has already taken steps. I think, in fact, today's news was that they are planning to start selling some lithium-ion batteries. I'm not sure exactly which segment, but Amara Raja at least is taking some steps towards this segment. Exide doesn't seem to be doing anything. Amara Raja also has a tie-up with Johnson, which has some capabilities in the lithium-ion segment. Exide, none of Exide's technical partners actually have any capabilities in the lithium-ion segment. So it will have to find newer partners Amara Raja that way is better off if this shift happens, but it will hurt both of them.
Okay, so that's the view. It's a negative view that's coming in from Amit. Chintan, do you think these are valid concerns, and what's your view on Exide as such?
So Exide, when I talk about, I'll split this segment into two different parts overall as an organization. One is the insurance business. Though the revenue stream from insurance business has been on the positive spree, though it's very minuscule, but yet there is a lot of value to be unfolded, which actually accounts 20% of the overall profitability of the organization. When you look at India as a country, the kind of a penetration of insurance business is only 4% of the overall GDP as compared to the developed markets, which has got a double-digit kind of a penetration. So when I talk about insurance as a segment per se for Exide, there is a lot of value to be unfolded. Yes, rightly pointed that it's too very early for us to comment on the insurance business, because the 80% of the revenue stream comes in from a business which is that of the storage batteries. When it comes to storage batteries, now understand that lot of buzzes around shifting the gears to electronic vehicles. But when we talk about Indian kind of a segment, it's at least another a decade or two more wherein the consumption of a lead-based batteries is not going to die and decay. So the business is going to go strong at least for some point in time. It's under some kind of pressure is what we see, because when you look at kind of the lithium which is required as a raw material, the lot of storage and deposit is all with southern part of America. There has to be a lot of government policy intervention to ease the import of all this particular raw material, which will help in manufacturing the lithium batteries, which is going to be the buzzword or a requirement for every electronic vehicles. It has already invested 700 crores kind of a capex in their Haldia plant, and that's rightly done with a joint venture with one of the Chinese companies. It's not yet out in open whether it is going to be completely for the production of lithium based kind of a batteries, but surely Chinese players happens to be one a major game changer when it comes to supply of lithium batteries in Indian markets. So surely this capex in joint venture is going to unfold some value for it. And moreover, when you look at last 1 year, prices of Exide Industry has not given a lot of upside, purely for the reason being that the core component which is lead, the prices of lead has already gone up by 24% in last 1 year span of time, and that is what has kept the prices or the stock prices under some kind of a control. The profitability has not come in. This year hopefully we see that Exide Industry is expected to do better, and rightly mentioned that in an organized sector it's a duopoly kind of a situation between Amara Raja and Exide Batteries. We see a fair upside of in the stock price of Exide, and we hold our bullish stance on Exide Battery.
Okay, so it's contrarian views that coming in on from both our guests. Amit is bearish on Exide Industries, while Chintan has given a bullish stance on Exide Industries. We'll move on to the next stock, and that is Mahindra and Mahindra. The counter is trading at fresh lifetime high. It's trading rather flat today, but if you're looking at where the stock price is, hit a fresh lifetime high in trade today. Is there more to rally? Is there more rally in the counter? If I look at the brokerage views, out of the 45 brokerages that cover it, 41 have a buy and 4 have a hold. So there seems to be a consensus bullish stance that's coming in on the brokerage side. But Chintan, do you share this bullish stance that's coming in, or do you think that the rally is pretty much priced in the valuations?
Okay. So M&M, if you look at the company again, 10% of its revenue is again from the financial sector, a very minuscule one, so we don't touch on to it. But talking about the remaining 90% kind of a revenue, so 45% is all into vehicle, which is the PV segment, and remaining 45% into tractor segment. Look at the kind of a growth that the company has shown in terms of sales. Yes, it is growing up. November numbers, if you look at it, approximately 20% kind of a jump is what has been seen in the PV segment, and more than 30% kind of a jump even in the tractor segment on YOY basis. So overall, if you look at it, yes, there is an increase in the sales which is happening, but overall it is losing its market share. Otherwise, when we look at it, when we look at the other peers in the entire industry, in the entire sector. Now the announcement that M&M has made is to come up with their other variants of into PV segments, which are 3 new variants, the tractor segment, and even a driverless tractor, which is expected to come somewhere in second half of 2019, which will give it some kind of a booster. Now not only this one particular aspect, but also look at the kind of a strategic tie-ups it has done, the kind of an integration. It's rightly integrated in terms of manufacturing its own batteries, its own components. So this is going to provide a lot of upside in terms of value chain. Overall, when we talk about Mahindra and Mahindra, we're not too very bullish as its peers like Eicher or Maruti Suzuki. But yes, we hold our stance to being very neutral to bullish kind of a stance in coming years.
Okay, what about you, Amit? Do you share the same view or you would have a different view?
So even I am neutral to bullish on Mahindra and Mahindra, and the reason I'm positive is M&M is probably the biggest beneficiary of rural recovery if it happens. The expectation is that the government will have to spend a lot more on the rural areas, largely because there has been some distress in that space. Even the election results have been pointing towards weakness in the rural markets for the leading governing party. So if there is a rural pickup, M&M is by far the biggest beneficiary. A large part of the value comes from the tractor business, which is entirely rural dependent. Even in M&M Financial Services, which probably accounts for 10 to 15% of the value of M&M, that would be a beneficiary of the rural pickup. However, the auto part is where it is weak. It has been losing market share, as Chintan mentioned. However, even the products that they sell, be it the Scorpio, the Bolero, all these products have a large rural angle.
Okay.
So if the rural pickup takes shape, then M&M would definitely benefit. However, the reason I'm still neutral on this is largely because of the valuation. It is priced higher compared to other auto companies, especially compared to the two-wheeler companies, where it has negligible presence. So it's trading at 27-28 times earnings, which is slightly on the expensive side.
Okay.
So valuation is a bit of a concern, but overall business might do much better than what it has done historically.
Okay, so that's again a consensus view that's coming in on M&M. Neutral to slightly bullish is what both of our guests have indicated on M&M. Let's talk about the third stock, and that is Oracle Finance. Again, the stock is trading at a fresh 52-week high. Yesterday, the count was up, and it's a stock that's in the F&O space. So yesterday, it moved up on very high open interest build-up. What's buzzing in the counter? Is this something that you would bet on? We'll ask our guest. Amit, I'll start with you. If you're looking at it, it's trading much higher than what the street has also. All the brokerages put together. The most bullish target is 4,020, and this counter is trading much higher than that. What do you make of Oracle Finance?
So I think when you just look at the valuations of Oracle Financial, it is trading at significant premium to other IT companies in India. But you have to remember that this is more a product-based business, while others are more services-driven businesses. So there is a difference in the business model. Oracle probably does not have the kind of challenges which the other IT companies have, where there is a risk that they might not be able to grow. Oracle at least is a beneficiary of the entire adoption of technology that is happening across the banking sector globally. So especially if the North American markets, which is picking up, there would probably be more core banking software sales that will happen to it. That's the largest market for Oracle. So the business is not as impacted as structural challenges as other IT services companies. However, the valuations are 60-70% premium to the likes of Infosys, TCS. So it's fairly richly valued, and therefore I'd be a bit neutral again on
But isn't that the case with most MNC companies, that even though they are not performing, valuations are always much higher because they are getting that MNC valuation, and it's a subsidiary of Oracle.
So essentially the reason why there's some premium also to it is there is always this buzz going around that this will get delisted, and therefore minority shareholders will get a premium to what the price that they hold. However, we don't know when that will happen. It's a speculative bet. Just because you believe that delisting, over the last 5 years, how many delistings have we really seen?
Not
so
much.
really to give a premium because it's owned by an MNC, I wouldn't say in terms of business quality, TCS or Infosys is anyway lesser, be it in governance, be it in cash flow characteristics. Oracle would be similar to them. Just because of its parentage, we should not be giving it a premium. And this entire delisting related thing, it does not really make sense. There isn't no justification to that.
That
thesis.
will happen in this thing. What about you, Chintan? Any view on Oracle Finance?
I would completely agree to the view. Oracle Financial Services per se, look at the kind of a revenue from Oracle Financial Services. KPO, revenue from KPO has been, ideally on the declining spree. Revenue models again from its, core service sector is again on the declining spree. So when you look at Oracle Financial Services, the revenue overall, we are not seeing a lot of growth in the revenue. So what is happening is with this particular counter that because of a lot of revenue which is getting built up purely because of the licensing, right? There is a lot of question mark whether the renewal of licensing is also expected to happen, and this particular question mark puts this particular stock under a lot of pressure. P valuation, it's almost at 33 kind of a P valuations, wherein the peers are already trading at somewhere close to 26, 27 kind of a P valuations. Overall, if you look at this particular sector, there is no great insights wherein we pick up the points and we say that this sector is, this particular stock is expected to perform much better. And upside could be very restricted because it has already given a lot of run up in last 1 year span of time. So we hold a very neutral kind of a stance on Oracle Financial Services.
Okay, so it's again a neutral stance that's coming in. It's a consensus view as a neutral stance on Oracle Finance. Before we move on, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, the next stock that we want to talk about is Mass Financial. The company recently listed. It's up almost 40% from the issue price. Is this a stock that you would bet on? Amit, I'll start with you. Mass Financial, any view?
So I like the business of Mass fairly a lot. This is a business which has been the company which has been in the small ticket lending for a very long time, much before small ticket lending became fashionable. So they have been doing in this business for almost a couple of decades now, and have had impeccable asset quality, have been growing at a very decent pace, and management has been fairly conservative, has not diluted significantly. Unlike other NBFCs where dilution is very normal, Mass has not diluted a lot. However, the risk that I see with Mass Financial is it's largely a lender to other NBFCs, smaller NBFCs. And now with a lot of the NBFCs turning into SFBs, they would not require the funding from Mass Financial. In fact, they will start competing with Mass because their cost of funds will become lower than Mass.
Okay.
Mass right now has around 9% cost of borrowing. The likes of Ujjivan or other small finance banks will have a much lower cost of funds. So they will start competing in that small ticket lending space with Mass Financial at a better cost of funds. So Mass's NIMs going forward should see more pressure. And the fact that we are seeing now even the PSU banks after recap will probably become more aggressive in this space. I don't see what we have seen in historical growth rates again being replicated into the future. So the ROEs that we have seen in the past of 25-30% may not sustain going forward. The bigger challenge with Mass is the valuation. Even if you were to assume that these competitive threats will not play out, the valuation is at exorbitant territory. We're talking about 7.5 times price to book, which is crazy for an NBFC. And we are not just assuming any risk at all to the business, while there are some risks that are there.
Okay. What about you, Chintan? Mass Financial?
Okay, to start with, it's a complete thumbs down to Mass Financial.
Okay.
The reason's very clear. The kind of a trajectory it operates in. It's a risky business. A major chunk of the business is in the wholesale space. So there are high chances that the books might go real bad. And if you look at the PCRs, which is the reserves for all the provisions to be made, it's only at 15%. So if there is even some threat from one of the wholesale players to go bad, the company is expected to incur a lot of losses. Amit rightly pointed out that the kind of valuations that it is already trading at, I would say that it's almost trading at 4 or 5 times the kind of valuations to its book value as compared to its peer like City Union or even Capital First for that particular matter. So overall, we don't see a very good potential upside from its IPO price. Yes, it has already given a significant run up, but look at the price ever since it has got listed. The stock has hardly shown any kind of an upside movement as of today from its listing prices. So there is a lot of pressure onto this particular stock and we don't see a lot of upside, but a complete downside onto this stock. We hold our bearish stance onto this stock.
So it's a consensus thumbs down that's come in on Mass Financial. We're running out of time, but we'll take the last one, and that is Tata Investment Corp. Stock is up almost 50%. Should one be betting on an investment company at this point of time? Chintan, very fast. What's your view on Tata Investment?
Okay, very quickly. the buzz about Tata Investment has been around, and very recently there was, early October, there was a news that Tata Teleservices, which is a loss-making arm, is going to get set off and given away to Bharti Airtel. The news has already got factored into the kind of a prices. The stock is already moved by approximately 50-51% over last 1 year span of time, and there are no great positive clues that we get in from Tata Invest Corp as this point in time. Overall, we have a very neutral kind of a view for a simple reason that one, there is no positive trigger to this. Second, when you look at the kind of a profitability, it's already started to show approximately 11% kind of a downtrend in terms of overall profitability. So till the time we have any positive clues coming in for this particular stock, we hold a very neutral kind of a view. And going forward, only we can, really come up and say
wait and watch
kind of a stuff.
Amit, what do you make of Tata Investment?
So I have a neutral view, but for different reasons. The reason why I partially like Tata Investment Corporation is because it's like a diversified mutual fund that's listed.
Yes.
However, the positives are, while a mutual fund would have a 2.5% expense ratio, a Tata Investment Corporation has only a 0.5% expense ratio. And the mutual fund, the company is available at a 50%, 55%, 60% close to discount to the assets that it holds.
Yes.
So what that means is basically if you directly had invested in the stocks that Tata Investment Corporation has a holding in, you would get twice the dividend that you would get if you directly held them. So you get higher dividend yield at a much lower expense ratio. So if there was someone who's looking to get an equity exposure, so instead of investing in, say, a mutual fund, if you invest in a Tata Investment Corporation over the longer term, you'd probably get a 3 to 4% higher return, which is substantial. Now, the way I would typically look to invest in Tata Investment Corporation is invest when the discount is fairly high. Right now, it's at around 55%. The discount has ranged between 45% to 60%. So when the discount starts becoming wide, I would invest in that and sell when the discount narrows. Right now, it's somewhere in the midpoint. So I would not invest right now.
It's a wait and watch.
Yeah, I'd wait.
You'd wait and watch the discount.
Yes.
Okay,
yes.
so that's the view that's coming in on Tata Investment Corp. Both neutral views that are coming in, and Amit rightly pointed out, it's a play when the discount widens. So if the discount widens, that's the time you should be accumulating, and sell it of the time when the discount actually narrows. Before we wrap up on the show, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, Chintan and Amit, thank you so much for joining me on the show. With that is a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg Quint.